Good morning. Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Sonia and Nigel. We've all had a restful weekend. Cheering for football, FIFA.
Hectic weekend. Sports was on everyone's mind, right, over the weekend.
Top of mind, right, Nigel?
Well, that's right. No, it didn't really. Yeah, Netherlands didn't make it through. Morocco made it through, but I'm gunning for them now.
This time for Africa.
This time's for Africa, like Shakira
And those
said.
videos were so sweet, right? About the Morocco team cheering with their families.
So
I mean,
true.
it was. It is the World Cup has been about the underdogs this time around, and I think taken it through the finish line.
And I guess Tuesday and Wednesday is going to be busy as well, right? With semi-finals and so.
Who are you going with?
A very busy one. You know, now I think it's going to be maybe France again, right? I think. I mean, the way they're playing, attack, defense, everything, I think it could be France.
It could be France. They have the team in there. I'm going with Morocco, as well as I believe that it's Messi's time. So maybe. Let's see how that works out. Let's get to markets.
All right, let's quickly tell you how things are set up before we go any further. Let me start with the US, right? Because that's basically where the big Q is going to come from. So this week, you've got two things to watch out for. You've got CPI, which is, of course, the day of the first semi-final, a FIFA semi-final, and the second is the FOMC with the day of the second FIFA semi-final. So you got the CPI data on the 13th and the Fed decision on the 14th, which is one day later. Now, why is this important? I think more than even FOMC decisions, the reaction of markets to FOMC lasts a day, 2 days, sometimes it reverses, but CPI usually is more pivotal. A stronger CPI could lead to a more stringent sounding Fed chair. A weaker CPI as compared to expectations could lead to a more benign sounding Fed chair, that is Jerome Powell. And I think that is where that's why this is important. A rate hike is very much given. I mean, a 35 basis point rate hike. So that's not what we are debating about. It's basically about commentary which the market will watch very, very carefully. By the way, I mean, if the producer price index, which the data we got on Friday is anything to go by, expect higher, not lower. But that is producer prices. We're looking at consumer prices, which is up next. A quick word on levels. I mean, this morning, SGX is indicating a lower start. And I think we will once again breach the 20-day. We are, by the way, exactly at the 20-day as of Friday's close, which is now moved up to about 18,496. And I think if that goes, and I think I put this level out last Thursday and Friday as well, the next level to watch, the really big one, is 18,133. I mean, actually, that is a medium-term kind of a level. That is nothing but the November lows. So 18,133 is the next one to watch, if 18,496. I mean, the market is not able to close around these 20-day moving average kind of levels. Closing is important. You may breach it like what we saw on Friday and then pull back like what we saw on Friday, but a meaningfully lower close below that average, I think, is what will count. The Bank Nifty is much stronger. I mean, actually, if anything, the Bank Nifty ended higher, right? Marginally, but it did end higher. On the Bank Nifty, if there is pressure on the downside, the level to watch is the low of 42,948, which is, I mean, the low of the last 3 or 4 days. So that's the first one to watch on the downside. You know, let's just do a quick word. The PSU Bank Index pulled back last Friday, and it did so on very high volumes. So that's a space that you want to watch. There is an upgrade, for Punjab National Bank. We'll come to that in a bit. But the index was down 1.7. Is it routine profit booking? Looks like it, but volumes for the PSU Bank space were the highest since February of 2021. And, when volumes spike like this and prices pull back after such a large move up, I mean, I think you need to be a little watchful. The real question is, where will support, leadership, etc. come from? Because IT, maybe not exactly after what HCL Tech did. Perhaps it is banks, private, if not public. But I think that is the stronger part of the market very, very clearly. SGX right now indicating about a 70-75 point lower start. Guys, hi.
Absolutely. And, this is an important week, right?
Yeah.
We head into the week with the US Fed meet, as you said. Perhaps the Fed is going to guide the markets this week. And ahead of that, there is some bit of tentativeness. It was a weak handover from Wall Street as well. The Dow is down over 300 points. The SGX is down about 70 points. Apart from the US Fed meet, there are two other central banks that meet as well. So there could be rate hikes across the board. There's the ECB meet on December 15. There's the Bank of England meet. And from the ECB's front as well, there's a 50 basis points rate hike expected. There's the US CPI data. So it's going to be data galore. And that perhaps is going to decide the trajectory of the market going forward. Now, the Nifty up until now has been range bound between 18,400 to 18,800. And on Friday, once again, we saw selling from FIs, although it was a very, very small amount. The flows have thinned down as they generally do towards the end of the year. Now, a couple of things. Our own markets have been pretty resilient amidst all of this global chaos. So, Credit Suisse came out with a note on Friday evening where they spoke about how there is a big sign of revival in the low-income consumption in India. And that perhaps could take the lower end of the market, with some recovery. They speak about how the services economy is normalizing, the government bottlenecks in spending are easing, and there is perhaps a potential 15% gain in forward earnings is what they talk about. Of course, there are a whole host of sectors as well, which we will discuss later. But given all of the global headwinds, I think the Indian markets are, a bit of an oasis maybe for global investors. Things have been looking good, although today we may start on the back foot, but then we'll take it from there.
Well, that's right, Sonia. In Friday's trading session, when we got into the final hour, you were hoping that we defend that 18,400 odd mark on a closing basis, and that's what happened because we ended closer around the 20 DMA. We pulled back in the final hour of trade, and the Nifty Bank, that was rock solid in Friday's trading session. Though the IT index has become a bit of a worry, was down close to 6% for the week itself. The problem on Friday was not the headline index, but the mid-cap and small-cap indices as well. They took a harder knock. The small-cap index was down 1.1%. The cues coming in from the F&O market, though, I would view them a little bit positively because we were getting very exuberant on the long side. The put-call ratio has cooled off to around 0.76. It was at around 1.04. Earlier, it was 1.3, 1.4 as well, so I like that. And the premium on the Nifty futures as well was 130, 140. Now, that's come down to around 87 odd. I think that's pretty good. There is some unwinding of long positions and some kind of, this is a more believable screen actually. The FIs in the index futures, they unbound longs. More than 6,000 contracts is what they unbound, and they added some shorts. And now the long-short ratio is at around 58% of their positions are on the long side. But the net long positioning, we've been talking about this, right? It was 90,000 at the start of the series. That came down to around 55,000 at the start of last week. And it ended the week at around 26,000 odd. So the net long positioning has come down drastically, which means the short positioning as well has got up, which is not such a bad thing. Moving to the option side of things, well, the FIs, they wrote calls aggressively. 2.3 lakh calls were written in the ratio of 3 calls for every 1 put. And it appears in Friday's trading session, the 18,600, 18,700 call, both of them very active. Between them, they added more than 1 crore shares. And there was aggressive writing seen out there. So the bears, they're going to come in and defend the higher levels. However, on the downside, the 18,400 put as well was fairly active, which brings us to the levels. Now, on the downside, you're looking at Friday's low. You're looking at the 20 DMA. Once we get up and above that level, substantially, then you'll be feeling good. So that becomes a bit of a resistance zone. On the downside, Friday's low. And since 18,400 put was seeing some bit of writing, you're counting on that 18,350 level holding out. So that becomes the buy zone, 18,350 to around 18,400 odd. Risk reward could favor the bulls. The Nifty Bank could pull back 1%, but still that's the strongest index because the 20 DMA is quite deep from here. And the breadth of the market, I like to see more participation. For starters, the SGX Nifty is suggesting a bit of a pullback. Risk reward will favor you closer around the 18,400 odd. What else, Sonia?
Absolutely. That's been the benchmark, so to speak, on the downside, right? The support level for the market, the 20 DMA of 18,400 to 18,500. This is something that's held for the last many days as well. A couple of things to watch out for. You have 3 IPOs that are kicking off this week. So there's a total of almost 1,900 crores that will be raised from the primary markets this week. Today, of course, we all know Sula Vineyards, the IPO opens up. The one I'm looking forward to is Landmark Cars tomorrow. It's Group Landmark, which we all know as a common brand. It's a TPG-backed premium auto dealership that launches tomorrow. So keep an eye out on Landmark Cars. And there's also Aban Holdings that will be launching its IPO this week. So lots of action on the primary market front as well that we'll be tracking. But first up, the SGX Nifty indicates that the opening will be on the weaker side and all eyes will be on the US Fed meeting later this week. So maybe some tentative moves ahead of that. On the equities front, though, we have a comment coming in from Neelkan Mishra of Credit Suisse, who says that the level of economic activity is now closer to the pre-pandemic path and the pace of growth is stronger than captured in data. He says a revival in government spending, low-income jobs and easing of supply bottlenecks should partly offset the effect of rate hikes, sharply slowing global economy. He also says a potential 15% gain in forward earnings may set the ceiling for returns over CY23. They prefer domestic cyclicals like financials, cement, construction and staples over discretionary, and they are underweight industrials, IT and metals.
Well, let's get you some money market views as well. B. Prasanna of ICICI Bank says that after recent correction led by expected softer inflation trajectory, dollar has consolidated in a range. He says, though the FOMC is expected to slow down the pace of hikes, any surprise in US CPI data will increase volatility in currencies through repricing of terminal rate and pivot timing. Rupee, he says, which is seeing persistent pressure of dollar buying from the RBI, and oil companies will remain volatile and trade in a range of between 81.75 to 81.9 for the week.
And on the bonds, B. Prasanna says global yields remain range-bound awaiting FOMC outcome. Back home, he says the MPC delivered a hawkish 35 basis points hike, resulting in the repricing of the terminal rate expectations. Yields drifted higher with supply concerns coming back to the fore. He expects the market to remain on the edge ahead of the CPI releases both in India and the US, and expects the 10-year benchmark bond yield to trade in a range of 7.2 to 7.4% for the week.